quite a few ways before you even get to sort of tax wrappers, potentially, of just minimising the tax that, say, a couple might be liable for, whether capital gains tax or income tax.
Each year, every individual has an annual exemption limit, and this is the amount of gains that can be made before any capital gains tax is actually payable. And this has been gradually increasing over the years and is currently £12,300. However, after the 5th of April this year, this will be more than halved to £6,000, and then next year it will be reduced further to £3,000. From the 6th of April, taxable income over £125,140 will be chargeable at the additional rate of 45%, and the threshold is currently £150,000, so there's quite a reduction there.
The importance of tax wrappers is sort of growing with these changes that are coming from this year and into next year. As Sarah mentioned earlier, the CGT allowance is coming down, and it's getting pretty much halved this year and again next year. Alongside that, the dividend allowance, the amount of dividends you can receive from your investments before you have to pay tax, is also coming down at the same time. It's going to be halved this year and halved again next year. The one thing I would focus on in terms of the time horizon, i.e. we've got the end of the tax year just down the road and then we'll be into a new tax year, is making the most of these allowances if you haven't already. If you have surplus cash or capital looking to invest, these would be the sort of first stop, port of call for getting that money invested in a tax efficient manner.
Now, the reason we're highlighting pensions at the tax year end is because if you don't use your allowance, you can lose it. Now, unlike ISAs, as well as I highlighted, where you will lose the allowance immediately if you don't use it by the 5th of April, now pensions have the benefit of allowing you to look back over the last 3 tax years and use up any unused allowance that may still be available from those previous tax years. Now, that's quite a unique benefit of pensions and gives those individuals that have not funded pensions for some time perhaps a second chance to make use of those allowances.
If you're looking to reduce the value of your estate, and if you can afford to do so, then one thing that you can do each tax year is make sure that you make full use of the annual gifts allowance. And it does soon mount up. So the amount that you can give away each year is £3,000, and that's whether it's made up of money or assets. So you don't have to give away cash, you could give away shares, you can give away anything. And you can give this to either one person or split that £3,000 between more than one person. And the benefit here is that if you didn't make any gifts in the previous tax year, you can carry the exemption forward to make gifts of £6,000 in total, but you can only carry forward for 1 year. And then as well as that, you can make special gifts when someone gets married, and you can make small gifts of up to £250 to as many people as you like, as long as none of those people have received your £3,000 or part of the £3,000.